Now, here's the host of Good as Gold, Nick Grovich.
Hi, this is Nick Grovich. I'm live in Phoenix today. If you have any questions, you want to join the conversation, you want to move it in a different direction, call me here at the station, 602-324-1510. If you have specific questions about your coins you may not want to ask on the air, maybe it's a little bit more private, you can always call the office. That's 480-553-5282. Well, finally, after having a couple of really bad weeks or months in gold, we had a rally. Gold was up for 5 out of the last 6 days. If you remember last week, I was talking about looking at the charts and looking at the open positions, the open short positions, that I kind of had a feeling that we were due for a little rally. Now it wasn't huge. We're up over $1,100. Gold's down $10 today. We're sitting right around $1,115. But we were down to $1,080. Platinum was down to $950 and bounced back up over $1,000. So that's a pretty strong comeback on platinum. It's just bouncing right around the $1,000 mark right now, and silver is in the mid $15 range. So, we had a pretty nice rally the last few days, or last 5 days, and today it gave back a little bit of that. Part of that is the dollar's a little stronger today. I mean, that seems to be what happens most of the time. The dollar is strong, gold goes down a little bit. What happened this week, as most people probably know, is on Monday night, China devalued the yuan by 2%. And then surprisingly did the same thing again on Tuesday. They devalued it another 1.6%. And that really sent the stock market down and consequently moved gold back up a little bit. I don't know if this is the start of a big rally or not, but for the last couple of weeks I've been saying that it really looks like we were overdue for some kind of rally. We have to realize is when gold moves, whether it's up, actually any commodity or any investment, when they move down or they're in a bull market, just as gold was when it hit $1,700, $1,800, $1,900, the sentiment gets behind it. People get very negative, and when it's going down, it has a tendency probably to go down farther than what the true value should be. And likewise, when it goes up, you have kind of a mania and people jump in at the last minute, and that's what gives us those tops. I mean, there's tops in the market because people are euphoric about it. They think there's no stopping it. If it's gone up and up and up, and they just keep jumping in, and that's what causes a top. And likewise, when you see a bottom, as we've recently seen, now I don't know if that's the bottom, but we've had a bottom at $1,080 on gold. It's the same thing. People get so negative that they sell into it, and what happens, a lot of it's not even the physical metals. What's interesting, and I mentioned this a little bit last week, is that when the prices were really, really low, it was actually really hard to buy certain items. You couldn't buy silver maple leafs. You couldn't buy silver eagles. The platinum, even the bars, maple leafs, eagles were basically non-existent for a while. So you get to a point where the price goes so low that the available physical metal that's out there for investors just kind of dries up. And a lot of that happens because, when it initially goes down, you get the people that are negative sell out. And we reached a point in the last 2 weeks where sentiment, depends which index, there's a million different indexes, but the miners index was at 0% bullish. Now, I assume bullish means that they think it's going up, bearish means people think it's going down. So if I say somebody's bullish, it means that they think the market is going up. Well, the sentiment by miners was 0%, so that means no miners, zero. Nobody thought it was going to turn around and go up. Other indexes that I've seen had the bullish sentiment as low as maybe 10%. So no matter how you look at it, that tells you that nobody really was very encouraged that the price of gold was going to turn around. And quite often, that's a good sign that we've reached a bottom, at least for the time being. It doesn't mean that things can't get worse. It doesn't mean that it can't go lower. Just because nobody thinks it's going up doesn't mean that there's no one left to sell. And a lot of that selling usually happens on paper. People will sell gold. When they short gold, that just means you're selling gold you don't own. in hopes of buying it later at a lower price. So if you shorted gold today at $1,115, let's say you shorted 100 ounces, and then gold dropped to 1,015. Well, by shorting it, you're selling it at 1,115, and then hoping you can buy it back cheaper. So you'd buy it back at 1,015 if it got there, and you'd make the $100 profit. So that's I mean, in a nutshell, that's what happens when the big commercial people are shorting. Of course, they're shorting more than 100 ounces. They're shorting, millions of ounces of gold and silver. So the other thing that I noticed about this, and I mentioned this the last 2 times I was on, is that even the short positions were extremely low. And that's always a good sign, because once people have sold out their physical metal, and then you have the paper trades, the options, the out and out short positions. Once those are very low, there's just not that much pressure to push the market back down. So those are they don't tell you exactly what's going on all the time, but they're really good indicators that the market's ready to turn around and go back up. And so you probably had some profit taking today. It was a fairly decent move, especially, like I said, in platinum and silver. Percentage-wise, they move pretty well. And so, if people are playing this in ETFs, or they're playing it in options or something like that, a lot of people are going to take their profits. It was a big move. It's up, $45 on gold, over $50 in platinum, and a little over $1 on silver here in the last 6 days. So that's a pretty decent move. Everybody calls and says, well, is this the move? Should I jump in? Shouldn't I jump in? And I think hopefully, if you're buying physical gold, silver, platinum, it's more as a hedge or as an insurance policy. You can see when the stock market and the dollar go down, gold generally goes up. Now, it's a very general statement. It doesn't happen all the time, but like I said, normally that's what happens. So the thought behind, for most people buying precious metals, is that they have something that will go up when their other investments might be going down. So it kind of lessens the loss if that happens. So a lot of people try and put 5 or 10% of their money into gold or silver or platinum, and that's really the reason. So hopefully, if you're buying, it's more for that reason, as a hedge or an insurance policy. If if you think it's easy to make money trading gold and silver, it's just like going to Las Vegas, because nobody knows. Even the best chartists in the world can't tell you with any degree of certainty what's going to happen tomorrow or a week from now. When you're reading a chart, you can explain what happened yesterday, but it's very hard to explain what's going to happen tomorrow. So, if you're in the gold market or silver or platinum and you think you're going to get rich quick, just realize you're taking a big risk. We'll talk more after this break.
Once again, here's Nick Grovich.
Okay, I'm back with you. We've been talking about the market in precious metals, which was up this week, which was a nice change from what we've seen recently. What I was saying is a lot of people buy gold and then they forget why they bought it. So I'm a big fan of having a plan. If it's a hedge and you're just buying something to put aside, yeah, you want to keep track of the price, because maybe it does something crazy and takes a big run up. Maybe you sell some of it, take some of your money back out. You balance your portfolio out. If you put 10% of your money in gold and it doubles in price, then all of a sudden you have 20% of your money in gold. So, at that point, maybe you take out your initial investment and you move on. But a lot of people buy it just because they think it's cheap, and then they think, well, when it goes up, I'm going to sell. Everybody wants to buy low and sell high. But then when it goes up, they don't have a plan. They don't know where their point is that they're going to sell. They just think that somehow, some way, they're going to know when the high is there. They're going to know where the top is, and they're going to sell out. So if you are buying more as an investment rather than a hedge, a good thing to do, in other words, if you're buying today at $1,115, maybe you think that $1,300 is the next support level. So maybe what you do is you ahead of time decide you're going to sell all or part of your gold at $1,300. Then when it gets there, instead of trying to make the decision while it's moving, because I guarantee it's a lot different when the market's moving than when you're trying to plan it out. When it gets there, follow through with your plan. Maybe you want to sell half of it at $1,300 and take some of your profits. Maybe you want to sell all of it at $1,300. Maybe you think it's going to $2,000. Well, then when it gets there, do something about it. What happens to most people is they buy it and they stick it away. And this is what happened in the past market, and it starts moving up, and they really don't have a plan. They don't know where they're going to sell their metal. They just think that for some reason they're going to know that it's time to sell. And I was mentioning this last week. I had a client who is an elderly woman out in Los Angeles, and she had spent $100,000 in gold years ago with me and had called and said she wanted to sell. Well, this is when gold was on its way up, so it was about $1,100 or $1,200. And when I got there, her daughter had convinced her gold was going up, which it did do, and she should just hold on to it. And the woman was very confused. She didn't know if she should hold it or sell it or what she should do. Well, at that time, her $100,000 investment was worth over $200,000. So I said, why don't we just take your original $100,000 back out, which we did. Then when it got up close to 1900, we did the same thing again. So she took $200,000 out, and she's still sitting on, I don't know what it'd be worth today, probably $70,000 or $80,000. So she still has almost her whole investment in gold, but she's taken her cost out twice. And to me, that makes a lot of sense because she had no plan at all. She was just, working on emotion. One day she wanted to sell, the next day she didn't want to sell. And you don't have to sell. It's not an all or nothing. You don't have to sell all of it. You can sell a third or a half or a quarter of it. So try and plan that out a little bit ahead of time if it's something where you're hoping to take some money out of this. If it's just something that you're going to stick in the closet or under the bed for a rainy day, that's a different story. If you start reading in the papers that gold's hitting new highs every day, maybe that gets your attention. You sell a little bit of it off. So, right now, it wouldn't surprise me to see gold go on a little rally. And I don't know if that means $50, $100, or $200. I think it's very possible it could do that. Now, the thing is, I can't tell you after that if it's going to test the lows again or if it's going to keep going. I just don't know. But, if you've been waiting to buy gold, it's not a bad place to start putting some gold aside. Put aside a little now. If it goes down, buy a little bit more. If it goes up, you can average your costs. So if it goes down or up, you're in a little bit cheaper by spreading your purchases out. I just read one article. When the market's weak, everybody comes out of the woodwork. Everybody's an expert, and everybody predicts lower prices. And as most of you know, right now, most of the bears, the people who think it's going down, they think it's going to $1,000. So we're really within about 10% of that low. And, if you're within 10% of what you think the low is, I would tell you, I wouldn't wait for that because 9 out of 10 times it never reaches the number everybody expects. Back in 1999, I remember this very clearly, because it was tough to be bullish on gold. Gold had been a little over $300, then it dipped down to $286, and eventually went down to $252 an ounce. And everyone picked $180 as the low for gold. So everybody was waiting for $180 gold, and it got to $252, and people just insisted on waiting for $180. Well, of course, the next thing it did, it turned around and went to $300. Then it went a little over $300, and they kept waiting for it to go back to $250. So I see that all the time. Well, it's $250 an ounce, and people don't want to buy. Then it goes to $300, and they'll call me and say, well, if it ever gets back to $250, I'll buy. And I think, well, it was just at $250. But when it's at $250, they want it for $200. When it's at $200, they want it for $180. So you're never going to, it's very rare you're going to get the absolute lowest price because we don't know what the lowest price is until it's gone. We don't know that that's the low until, weeks later when it starts, or weeks or months or years later sometimes. So at some point, you just have to pull the trigger if you're going to get in. But I read this one article where this one group is predicting $300 gold, and everybody has their own formula. They have this formula that they use, and they base it on what gold did over the past 20 years, and the highs and the lows and percentages. And as I read it, they feel like gold's worth. However, they came up with a fair value. I don't know how they did that, but they said their fair value is 825, but they think the momentum could take it down to $300 or $350. I guess my point is everybody has a reason, everybody has a formula. Only you can decide if it's cheap, and that's the best thing I can tell you. You buy when you think it's cheap, you sell when you think it's expensive. Maybe that's oversimplifying, but that's really what all there is to buying and selling gold. Let's see here. Oh, the one thing they did say in this survey, this group that was calling for $350 gold, and I thought this was kind of important. They conclude by saying that over the long term, gold does in fact keep up with inflation. And that's kind of a common, I don't want to call it a myth, that's kind of a common factor in gold. That's something that most people believe, that gold does keep up with inflation. But you have to remember it doesn't keep up year by year by year. So if you bought gold in the last few years, if you bought it at $1,500 or $1,700 or $1,800, now that gold's $1,100, you're not probably feeling that gold's really keeping up with inflation too well. So a lot of it has to do with where you buy. But over the long term, and long term can be decades. It doesn't have to be months or years. It could be decades. It could be, centuries really. But over the long term, and I mean the really long term, it does keep up with inflation. But again, it just all has to do with where you buy. So I'm a big fan of buying, Gold peaked out at $1,900. We're at $1,100. That's a pretty big drop in price, and I'm a big fan of buying when things are that low. So the other thing I wanted to talk about just briefly, and I'm going to talk about coins a little bit more, is that there's a little good news even with the market up. For a while, the mint was out of silver eagles, and the Canadian mint was out of Canadian maple leafs. And so what happens is when we're in a market that's this soft, a lot of the selling has already taken place. So we don't get a lot of investors calling and selling materials. So the dealers are dependent on the new issues from the mint. So in other words, usually if I call a supplier, they'll have a lot of metal on hand from people who decided to sell. I mean, the price is determined by buyers and sellers. So there's someone selling and someone buying. So there's usually a lot of metal available. When we get in a situation like this where almost everyone is negative, people have already sold their metal. They're not. If you're negative on it, you've already sold. So what happens is we don't get the older coins coming back on the market. And therefore, we have to depend on the refiners to make new bars. We have to have the mints make new coins, and everyone's waiting for the same thing. Well, when that happens, the premium on the coins generally goes up, and the premium, just to make sure you understand that's what you pay over and above the actual price of the metal. So, for example, on a gold eagle, the premium, it cost me almost 4% over spot to buy those from the mint. On silver eagles, it used to cost me $2.50 over spot. When the mint ran out of it, it ran up to $3.50 over spot. Now that's my cost. That's not what I sell them for. So the good news is if you missed the low in silver last week, that premium has actually come back down. So you're actually paying the same price today with silver higher as you were paying last week when silver was almost $1 lower. So that's kind of good news for you. You can kind of go back in time and still buy at last week's price, but it's the premium that you're saving. We're getting ready for another break. I see I've neglected to tell you who won our quiz and predicted gold for Wednesday's close. I'll go over that when I get back, and I'll give you a question too.
Once again, here's Nick Grovich.
Okay, Nick Grovich, I'm back with you. We've been talking about the precious metals. I'm going to switch gears a little bit here. Let's do a little trivia question. It's a really easy one this week, so it's good for one silver eagle. In the United States, unlike most countries, any of the coins or currency that was made in the past is still considered legal tender. So if you have a Morgan dollar from 1880 and you want to spend it as a dollar, you can do that. It's still a dollar coin. Now, of course, it's worth $20 or $25 because it's silver. But if you wanted to spend it as a dollar, you could. If you had currency from the 1800s, we call them the horse blanket currency because they were real big pieces of paper that they used. I think you'd be crazy to do it, but you can spend that money. So you can spend anything the government's made. But there is one coin that is not considered legal tender. So, if you're a coin collector, you probably know this without even looking it up. So let's get somebody who didn't have to go look this up. It's an easy question. What coin is it that the United States made that is not considered a legal tender coin? Okay, that's a pretty easy one. So somebody should get that right off the bat. I was talking about bullion, but I'm gonna talk about coins a little bit. The reason I'm talking about coins a little bit more lately is, as most of you know, I haven't recommended rare coins to my clients in probably 25 years or more. And when I say I haven't recommended them, I mean as an investment. And it's been a really good call because very few people have made money in the rare coin market the last 25 years. Are there exceptions? Yeah, there's a few exceptions. Even with gold down, you would have done better off, again, depending on when you bought, you probably would have been better off just buying gold or silver than buying most of the rare coins had you bought back in 99 or 2000, 2001. Even, like I said, even with gold down, it's still up over 300% in price, which is not a bad return. But, coins like the big $20 gold pieces, the St. Gaudens, the Liberties, the $10 Liberties, coins that really didn't have a big premium over gold. Some of those coins have indeed gone up with gold, but not nearly as much as gold spot. So for example, an MS-63 St. Gaudens, if you bought those back in 2000, you might have paid $500 or $600 for it, and today it's worth $1,100 or $1,200. So you would have doubled your money, but that's considerably less than gold going up, what is about 350%. Well, it looks like I have a caller, so let's take a break. Hi, this is Nick.
Hey, Nick, this is Rich.
Hey, Rich.
Arizona City.
Yeah.
Hey, okay, I'm going to take a wild guess. Maybe
All
I'll
right.
get it. I'm still new to this coin thing, so.
That's okay.
Is it the trade dollar?
It is the trade dollar.
Yeah.
All right. We're keeping you out of the doghouse, huh, Rich?
Yeah, I guess that's too. Well, at least I got this one right. You didn't have to give it to me.
Yeah, well, good.
You're nice. You're a nice guy, though, so.
Well, thank you. Well,
So,
Rich, thanks.
Is that
that's
answer correct?
exactly the right answer.
Oh, wow. Some of that reading, I read a ton, but only a little bit of it sticks. So
Yeah,
I used
well-
to play a lot of sports, and I think I suffered a few head injuries.
Well, there's a lot
So-
to know. So if you can read and remember a quarter of it, you're probably doing good. So the
Yeah.
trade dollar was issued in 1873 until 1885, and you have to remember back in the 1800s, the dollar wasn't it wasn't basically the world currency. So back in the 1870s, it was actually the Mexican peso that was used more than anything else. Even in this country in the 1700s, it was mostly the Spanish and Mexican money that they used here for trade more so. Well, of course, we didn't have a mint back in the 1700s until 1793. But the trade dollar initially was made for trading in Asia, and what they did to try and compete with other dollar-sized silver coins, because that's everything was based on how much silver was in a coin, and that's how different coins became popular around the world. It didn't really matter who made the coin; they were just based on, like I said, the amount of silver. So a regular silver dollar, a Morgan dollar, a peace dollar, has 0.7734 ounces of silver in it. So 0.77, just over 3/4 of an ounce. And a trade dollar has 0.7874. You think about it, that's a tiny amount of silver, but that brought it more in line with other countries' silver. What we call them crowns. A dollar-sized coin is called a crown. So the government was trying to get more into Asia, get our currency more accepted in Asia to obviously increase trade. And so they came up with the trade dollar. And initially they were issued as a legal tender coin, but because they had more silver in them, they decided to make it, I don't know what you'd call it, well, not legal tender. So it wasn't really something that legally could be traded here in the United States as a dollar. And of course, the reason for that is they had more silver in them. So people would, if you were trading dollars and you were getting paid, of course, you'd want the coin that has the most silver in it. And it's interesting if anybody has ever seen silver dollars at a coin show or ever bought them. A lot of them are counter stamped. What would happen is as they got to the Orient, the different merchants would look at the coin and basically decide if the coin was good or not. And a lot of times what they'd want to do is they'd want to make sure the coin was silver. In other words, it wasn't something plated or something inside the coin like lead or something like that. So they would take a counter stamp and they would hit it with a hammer basically. And it would be, have Oriental characters. So it might be the guy's initials or name or something like that. And I've seen trade dollars with 50, 60, we call them chop marks because they would just take their counter stamp and chop into it. And it would go fairly deep into the coin. And, a lot of times you'd see it on both sides of the coin because they'd counter stamp it to make sure the coin was solid silver. And that's a whole nother area of collecting. A lot of people collect those coins because they are counter stamped. Some people don't like the counter stamps because it's not original to the coin, but a lot of people like the idea that that coin actually was over in the Orient and was traded and are counter stamped. So it's a fun, like I said, it's if you're a collector, it's a real fun area. They made the coins 1873 to 1885. The last 6 years they made them. They only made proof coins, so they didn't really release the coins. If you were a collector, you could buy one. And you could buy these coins, a decent circulated coin, a coin you can look at. It's still going to have a lot of detail. You probably pay close to $200 for one of those for a decent coin. But if you want to get a high grade coin, they go into the tens of thousands of dollars for some of these coins. I think the 1885, the last year they made them, I think one of those went for over $2 million recently. So it's the fun thing about coins like this. If you're a beginning collector, you're just interested in it, for a few $100s, you could buy a coin and really get involved in it. If you're really serious, you can spend $500,000 or $2 million on a single coin. So, there's something in there for anybody if it fits your portfolio or if you enjoy the coins. And that's what I was getting at with the rare coins. I think with the precious metals down, I think you're going to start seeing a lot of the hard money people, a lot of the bullion people are going to start looking for alternatives. And, the same thing happened back in the 80s. Gold had dropped from $870 in 1980. And by, 1984, 1985, the coin market was starting to come out of its doldrums. It dropped very heavily along with gold back at that time. But people were looking for alternatives. They were looking for something different. And the rare coin market, it's kind of a natural because most of the coins that we trade are gold and silver. So it was kind of a natural for gold and silver buyers to turn to some of the numismatic coins. And of course, from 1986 to 1989, we had, I think it has to be the strongest coin market in history. We had increases of 300, 400%. And when I say that, I mean, that was very, very common. It was not uncommon to see coins that had gone up 4 or 5 times from 1985, 86 till 1989. So it was a good time. Of course, a lot of people didn't sell in 1989. I gave a recommendation to sell, but a lot of people, they see it going up, and just like gold, nobody wants to sell when it's high because they always think it's going higher. I don't think you're going to see that kind of move again. I don't think it's going to be a market-wide move in rare coins, but I do think at this point, for the right person, it's worth looking at some of the rare coins right now. And what I've been trying to do is talk about a different area of the market. Maybe not every week, but at least once a month. We talked about the barber coins on a couple programs. So today I was going to talk a little bit about the seated Liberty coins. And I started to do this last week and ran out of time, so I'm going to dedicate the last segment here after this break coming up. We're going to talk about the Seated Liberty coin. So Seated Liberty, it's exactly what it sounds like. On the obverse of the coin, there's a stylized Liberty in a long flowing gown, and she's sitting down. She has a shield that says Liberty on it. And on the reverse, there's a heraldic eagle. There's an eagle on the back with spread wings. And it's a real classy coin. It's a real a classic coin, and it's very well known within collector circles. Even if you're an unsophisticated investor, if you know anything about rare coins at all, you've probably seen or heard of Seated Liberty coins. They made them in all denominations. They made the half dime, which is half the size of a dime. It's worth 5 cents. Back then, they made 5-cent pieces were made out of silver, not nickel. Then they made a Seated Liberty dime. They made a Seated Liberty quarter and $half, and they even made a Seated Liberty dollar. But the coins I'm looking at right now are the dime, the quarter, and the $half. Those are the most widely collected coins. And it's really interesting if you look at them. They made 4 or 5 different varieties of coins. There are some very rare, like any other issue, there's some very rare issue that could cost you in the millions of dollars, and there's common coins you could pay for $25.
Once again, here's Nick Grovich.
Nick Grovich back with you. Before I go on about the Seated Liberty coins, I was reminded during the break that I did not tell you who won our gold quiz. If you don't already know, we have a weekly quiz. You have to guess what gold will close at, what the spot price closes at every Wednesday. Now you have to get your guess in by Tuesday, because we can't let you watch the market all day Wednesday and then guess at the close. So we had twice as many people participate this week as we have the week before. So it costs you nothing. Go to the website, AmericanFederal.com. There's lots of good information on the site. You can sign up for my email service. It's on there. It's called the Preferred Client Service. We try and give you updates on the market, let you know what's going on. So try that out, and go on there. We have a quiz, and what we try to do is see what you think the market's doing in gold. The last few weeks, gold didn't do much, so it wasn't that hard. Everybody got within a couple dollars. And what we do is we'll give you a silver eagle if you're the closest to what gold closes at on Wednesdays. And if you get it exact, maybe not to the penny, but to the dollar, I'll send you a $5 gold eagle. That's a 10th ounce gold coin worth about $125, $130. So this week it was Jay in Illinois, and his guess was $1,112, and the actual close was $1,125.50. It's the highest close we've had in quite a while. So Jay, if you're out there, we're going to send you a silver eagle, and everybody else, get on there and try it. It doesn't cost anything. Maybe you get a free ounce of silver out of it. Also, if you check the website, we are going to start doing some seminars again in the fall. So, check back there in a couple of weeks, and we'll start getting a schedule together. And as always, if you need some personal questions answered about your portfolio, or if you're just new to this and you want more information about gold, silver, platinum, maybe you don't know, maybe you have never done this, maybe you're just thinking about it, call the office, talk to one of the guys. We have Brian, Bob, Don, Carl, and me, or one of us is always there and can talk to you about whatever you're thinking about, whether it's buying, selling, getting involved. And we're happy to give you a lot of information. We don't, if you call, don't worry, we're not gonna attack you and make you buy something on the first phone call. We'd love to get you some information so that you can, make the right decision for whatever you're looking at. And so call the office. If you're in Phoenix, it's 480-553-5282. If you're outside the Phoenix area, we have an 800 number. It's 800-221-7694. So what I was talking about are the Seated Liberty coins. They're a classic collected coin. They're very, very, very popular with collectors. And that's one of the keys to it. You can find a lot of coins that are very rare that almost no one collects, and that's where some people get sidelined. They look at the rarity only. There's just a lot of other factors that go into it. You have to look at how popular the coin is. If there's a coin that there's only 10 made, but there's only 2 people looking for it, it's not going to go up in value. So you want to get in where there's enough coins to trade hands. I'm not usually a big fan of buying coins when they're so rare that there's only 1 coin or 5 coins or 10 coins, because the problem you get when you get something that rare is unless we just find a collector looking for the exact same coin, there's not enough coins out there for people to start raising bids on, if that makes sense. So if there's 200 or 300 coins, I know I can put a bid out there and I've got a good chance of finding one of those coins. If there's 5 coins, I could put a bid out there, double whatever today's price is, and I may not ever find a coin. So when they're that rare, generally we just wait till the coin comes up and then we negotiate on the coin. But if you're an investor, that's a tough way to do it because you don't have a big demand for your coin. So I try and look for these areas of the market like the Barber coins and the Seed of Liberty, where there's a small enough number of coins that if prices go up, you're not going to see coins come out of the woodwork, but there's enough coins out there that people think there's a reasonable chance of finding one. And I'm also going to share with you my old method of finding undervalued coins. I don't want you to go use this method just I'll explain it in a minute. It's what I used to use before I became a coin dealer, and it's kind of fun. So the Seed of Liberty coins, what I'm looking at are the proof coins. Now, if you understand what a proof coin is, that's a coin that's made specially by the mint. They still make them. Everybody's probably seen the proof sets and mint sets they make every year. They make a proof example of every coin they make. And a proof is they take the planchet. The planchet is the blank coin, and they polish that up to a mirror surface. Then they send it through the presses, and with a normal coin, a coin that you'd get in your pocket and change, they strike it once, they kick it out, and they throw it in a bag of other coins. So, they usually are marked up, scratched up. But those are just going into circulation. They're for commerce, so they don't really worry that much about the quality on those coins. The proof coins, they sell individually to collectors. And when you get back into the 1870s, 1880s, 1860s, you have to realize there weren't that many collectors, so the mint didn't make that many proof coins. And a proof coin, the older proof coins, they're generally they're struck twice, so the detail's very, very high. Sometimes the edges of the coin are so sharp, are actually sharp. They're very, very defined, and they generally have a proof-like or a mirror-like finish on the coin, on the background of the coin. Now, once in a while, it gets further complicated. They'll get a cameo effect. If you know what a cameo brooch looks like, it's like a black and white effect. It's the device is the Liberty or the Eagle. It gets kind of a frosty look to it. So if you get a cameo coin, they're actually worth a little bit more because they're even rarer. Most coins did not come out with that frosty look at them. Usually it's just the first coins out of the dies would have that frosty look. So that's even more desirable. So when I look at the dimes, for example, in proof condition, in proof 65, there's only a little over 1,600 coins graded. In proof 66, there's just under 1,000 coins. And in proof 67, there's only 346 coins. That's a tiny, tiny amount of coins. You figure that the government made, now these were made from 1866 until 1891. So they would make anywhere from 500 to 1,000 coins a year. And out of that number, only 346 of those coins have survived in proof 67. Now that number will grow. I mean, more coins will show up. So that number, does tend to grow over time. But I guess what I look at is they've been grading coins since 1986, so we're coming up on 30 years worth of grading. And I don't know how many millions of coins. They have the number on the website at PCGS and NGC, but it's tens of millions of coins have been graded. And so only 346 have shown up in proof 67. So that tells me that coin's very, very low mintage. Now here's a little trick I used to use, and it looks like I'm running out of time yet again this week. But what I used to do to try and figure out the relative scarcity of a coin is I would take the number of coins available and multiply that times the price. So, for example, on the Seed Liberty dime, you've got 1,647, and they go for about $1,100 a piece. So you multiply that, and you come out with 1.81 million. So I chop the last numbers off. I keep the first three, and that would give me a value of 1.81. If I look at the half dollars, it's 346 times the going price of 3,000. You multiply those, you come out with a number of 1.03. So comparatively, it tells you that the half dollar at $3,000 in proof 67 is undervalued in comparison to the dime, which comes out with a value of 1.81. And you could do the same thing. I know I'm running through this a little fast because I'm running out of time, but maybe I'll talk about this a little bit more next week. You can do that through any series of coins. I used to do this and take, for example, silver dollars. I do that with each silver dollar. And then you can see which coin within a series is undervalued compared to the others. But if you wanted more information, call the office. We'll be glad to give you more information.
You've been listening to Good as Gold with Nick Grovich.